Everything changed in under 72 hours, and almost no one is explaining it clearly. If you own gold or silver, you're not just watching prices move, you're watching the rules of the global system bend in real time. Two separate shocks hit back to back. One came from Washington, the other from the Middle East, and both are pointing in the same direction. Let's start with the shock that blindsided markets. The Supreme Court ruled 6-3 that President Trump's sweeping tariffs were illegal. The law used to justify them, the International Emergency Economic Powers Act, does not authorize broad import taxes. 6 justices agreed, 3 dissented. That framework, which reshaped global trade for over a year, was struck down. That alone would have been historic. But the story didn't end there. Within hours, a new executive order appeared, a 10% global tariff, this time under Section 122 of the Trade Act of 1974, a law that has never been used in 52 years. Then, less than 24 hours later, that rate was raised to 15%, the legal maximum allowed under that statute. Pause for a second. The highest court in the country blocks one tariff regime. A new one replaces it almost immediately. Different legal authority, different expiration timeline, same global impact. Section 122 allows tariffs up to 15%, but only for 150 days unless Congress extends them. That means there is now a countdown clock attached to U.S. trade policy. Think about what that means for businesses. Before the ruling, effective tariff rates were around 16%, the highest since 1936. After the legal reset and rapid response, they fell into a range of roughly 7% to 10%, depending on the country. China's rates shifted from about 45% to around 35%. The European Union remains at 15%. In other words, the legal structure changed. The uncertainty exploded, but the cost pressure barely moved. And then comes the part few are discussing. Because the earlier tariffs were ruled unlawful, importers who paid them in 2025 and 2026 may be eligible for refunds. The estimates suggest up to $175 billion. That money would come from a treasury already running a deficit of over $2 trillion per year. Read that again. A potential $175 billion refund obligation layered on top of $2 trillion in annual deficits. That is not a small accounting adjustment. That is systemic strain. Here's the reset moment. Gold doesn't care which statute authorizes a tariff. It responds to instability. Silver doesn't track legal arguments. It tracks volatility and supply pressure. And what just happened didn't reduce chaos. It multiplied it. Now there's a 150-day deadline. Congress may extend it. Courts may challenge it. A new emergency declaration could emerge. No one knows. From the perspective of a global manufacturer, how do you plan 5 months out? From the perspective of a central bank, how do you assess dollar stability when policy frameworks can disappear overnight? You hedge. You diversify. You buy assets that don't depend on legislative timelines. That's the first half of the storm. But while trade policy was unraveling in Washington, a different clock started ticking elsewhere. And that clock may carry even bigger consequences. Now layer this on top of everything you just heard. A 10 to 15-day ultimatum. That's the window President Trump reportedly gave Iran to reach a nuclear agreement or face consequences. His words included the possibility that we may have to take it a step further. When pressed, he referenced U.S. strikes on Iranian nuclear facilities last June. This isn't abstract rhetoric. 2 aircraft carriers are now positioned in the region, dozens of fighter jets. The USS Gerald R. Ford, the largest aircraft carrier in the world, entered the Mediterranean heading toward the Gulf. According to the information being tracked, this is the largest American military buildup in the Middle East since those strikes last June. And it's happening under a visible deadline. Attention reset. Deadlines compress markets. Military buildups amplify them. Then a headline drops over the weekend. The US has accepted Iran's demand to maintain uranium enrichment. On the surface, that sounds like de-escalation. Peace talks progressing, tensions easing. But here's what matters. The sourcing traces back to ESCALATED, the Iranian students' news agency, semi-official Iranian state media. Quoting an unnamed Iranian diplomat, Not a US official, not the White House, not the State Department. Timing matters. The report surfaced when markets were closed. Gold was sitting above 5,100, silver above 84. If you were short metals or waiting for a pullback, a peace-flavored headline at that moment could create exactly the kind of dip you need. That doesn't mean the report is false. Based on what the source material describes, it means the signal is thin, and thin signals move volatile markets. Iran's foreign minister has stated that a deal is achievable. He mentioned guiding principles discussed in Geneva and said a written draft could arrive within 2 to 3 days. That's more constructive than the tone 3 months ago. But the core sticking point remains. Missiles. Iran may signal flexibility on nuclear enrichment levels or centrifuge counts, but its ballistic missile program is widely described as a red line. Israel insists missiles must be dismantled. The US wants them constrained at minimum. Here's the hard truth. For Iran, missiles represent deterrence. For Israel, those same missiles represent existential threat. They can reach Tel Aviv in under 12 minutes. Both positions are structural. This is the reset moment. When two sides define security in opposite directions, compromise gets thin. Even if nuclear parameters move, the missile issue remains. So what does that mean for metals? If a full agreement materializes and sanctions ease, the immediate fear premium could soften. Gold might pull back 3 to 5% in a relief move. Silver could retrace more sharply in the short term because it carries both safe haven and industrial demand characteristics. But even in that scenario, the tariff clock still ticks. The $175 billion refund issue still looms. The $2 trillion annual deficit doesn't vanish. If talks collapse and limited strikes occur, the move could be violent. Gold pushing toward 5,300 or 5,500 in days is within the range being discussed. Silver would likely follow with amplified volatility. Oil spikes. The dollar initially strengthens, then potentially weakens as fiscal costs mount. And there's a third path: no deal, no strike, deadline extended. Military assets remain as leverage, tension sustained. That scenario embeds uncertainty into pricing without resolution, and sustained uncertainty is oxygen for gold. So now you have two countdowns running simultaneously: a 150-day trade policy timer and a 10 to 15-day geopolitical ultimatum. Neither offers clarity. The next question is this: how are markets actually responding beneath the headlines? Because the data is telling its own story, and it's not subtle. Step back from the noise and look at what prices are actually doing. Gold is holding above 5,100. Silver is trading above 84. These are not panic spikes. These are elevated, sustained levels. That distinction matters. When markets expect resolution, you see quick surges followed by sharp reversals. When markets expect prolonged instability, you see something different, a staircase pattern. Up, pause, up again, no dramatic unwind. That's what we're seeing. Now focus on the ratio. Just weeks ago, when gold was at 5,000 and silver was at 77, the gold-to-silver ratio sat around 65. Today, with gold above 5,100 and silver above 84, that ratio has compressed to roughly 60. 5 points in weeks. That compression signals capital rotating more aggressively into silver on a percentage basis. It suggests investors aren't just hedging fear, they're positioning for structural tightness. Attention reset. Silver is not just a hedge, it's an industrial input. Solar panels, electronics, medical equipment, defense systems, electric vehicles. Every one of these sectors consumes silver, and the market has reportedly been in a supply deficit for 5 consecutive years. Now add tariffs to that equation. Section 122 tariffs reach up to 15%, but critical minerals were specifically exempted. Silver is listed as a U.S. critical mineral. That means silver imports are not subject to the 15% tariff. Think about the relative impact. If competing industrial inputs become more expensive due to trade barriers while silver does not, silver gains cost competitiveness in manufacturing. That dynamic can increase demand rather than suppress it. That's not theory. That's incentive alignment. Meanwhile, central banks have been purchasing gold at record pace for 3 consecutive years, exceeding 2,500 tons annually, according to the data referenced in the source material. That buying has not slowed. Why? Because reserve managers aren't reacting to one headline. They're reacting to systemic unpredictability. Trade frameworks overturned by court rulings, new legal authorities invoked within hours, expiration clocks embedded into policy. From Tokyo to Berlin to Brasilia, the message is the same. The rules can change overnight. Gold doesn't require congressional extension, silver doesn't depend on judicial interpretation. And then there's the fiscal layer, a potential $175 billion in tariff refunds, over $2 trillion added to national debt annually. According to the data in the document, that math doesn't ease pressure, it compounds it. Here's the reset. Precious metals respond to 3 forces: monetary stress, geopolitical tension, and structural supply imbalance. Right now, all 3 are active simultaneously. Tariff instability adds monetary strain. The Iran deadline injects geopolitical risk. The multi-year silver deficit tightens physical supply. That stacking effect is unusual. Usually markets digest one catalyst at a time. A rate decision, an inflation print, a diplomatic breakthrough. This time, catalysts are overlapping. Supreme Court ruling, immediate executive response, 150-day expiration window, $175 billion refund exposure, 10 to 15-day Iran deadline, aircraft carriers deployed. Peace headlines with thin sourcing. There is no breathing room. And when markets don't get breathing room, they don't unwind risk, they hedge it. So the real question becomes, is this a temporary spike in uncertainty, or a preview of a longer trajectory? Because if it's the latter, the implications extend far beyond the next 2 weeks. And that's where the deeper structural risk comes into focus. Here's the part most commentators are skipping. This isn't just about tariffs, it isn't just about Iran, it's about trajectory. Look at the pattern. Trade policy built over a year gets invalidated overnight. A new framework replaces it instantly. That new framework expires in 150 days unless Congress acts. Meanwhile, courts may still review the alternative legal basis. That's not stability. That's institutional friction. Now layer fiscal reality on top. The US is adding over $2 trillion per year to its national debt. On top of that, importers may be owed as much as $175 billion in tariff refunds for payments made in 2025 and 2026. According to the data referenced, that money would have to come from the Treasury. So you have deficits expanding, potential refunds pending, trade policy under legal challenge, and geopolitical tension escalating simultaneously. A tension reset. From the outside looking in, what does that signal? If you're a foreign government holding dollar reserves, you're watching executive and judicial branches clash over economic authority. You're watching major policy tools reversed and rebuilt in days. You're watching expiration timers attached to global trade. Confidence doesn't evaporate overnight. It erodes gradually. That erosion is why central banks have been accumulating gold for 3 straight years at over 2,500 tons annually. Not because of a single event, because predictability is declining. Now zoom out further. The Supreme Court ruling didn't eliminate tariffs, it changed their legal wrapper. China remains around 35% under the revised structure. The European Union remains at 15%. Effective global rates remain historically elevated. So inflationary pressure doesn't vanish, it shifts. Meanwhile, the Middle East situation has no clean resolution yet. Even if nuclear parameters progress, the missile issue remains deeply entrenched. Aircraft carriers don't reposition overnight. Military buildups don't disappear on optimistic headlines. So what does the system look like? High debt, legal uncertainty, trade friction, geopolitical brinkmanship, structural supply deficits in key commodities, and countdown clocks attached to both trade and diplomacy. That combination doesn't scream temporary correction, it signals ongoing repricing. Here's the critical distinction. Markets can absorb one shock. They struggle with overlapping stresses that don't resolve. When there's no clean outcome, no definitive peace, no permanent trade framework, uncertainty becomes embedded. And embedded uncertainty behaves differently than panic. Panic spikes. Embedded uncertainty grinds. Gold above 5,100, silver above 84. Those levels reflect market's positioning, not reacting. And here's something else to consider. The Dow to gold ratio is reportedly sitting at levels last seen in 1973, just before gold moved from 180 to 850. That historical comparison doesn't guarantee repetition. It does suggest structural tension building beneath equity valuations. Reset again. This isn't about predicting a single explosive week. It's about recognizing cumulative pressure. Debt doesn't shrink. Trade disputes don't simplify. Geopolitical rivalries don't dissolve easily. And legal authority conflicts don't inspire investor confidence. So the real debate isn't, will there be a dip next week? The real debate is whether the system is becoming more predictable or less. If the answer is less, then precious metals aren't reacting irrationally. They're recalibrating. And that brings us to the final question. What happens next? And how should you think about positioning in a landscape like this? So where does this go from here? Short term, the next 2 weeks are a pressure chamber. The 10 to 15-day Iran window creates a binary event. A formal agreement could trigger a relief pullback. A limited strike could ignite a sharp spike. A quiet extension keeps tension alive without resolution. Each path moves prices differently. But zoom out. Even in a deal scenario, tariffs remain under a 150-day clock. Even in a strike scenario, deficits don't shrink. Even in a muddle-through scenario, uncertainty doesn't fade. That's the key. We're not looking at a single catalyst. We're looking at stacked catalysts reinforcing the same trade. Attention reset. If a deal materializes quickly, a 3 to 5% dip in gold is plausible based on how risk premiums unwind. Silver could retrace more in percentage terms due to its dual nature as both safe haven and industrial metal. But would that erase structural deficits? Would it cancel the potential $175 billion refund exposure? Would it resolve $2 trillion in annual debt expansion? No. If limited strikes occur, volatility accelerates. Gold pushing toward 5,300 or 5,500 in days has been discussed within the framework of escalating conflict. Silver likely follows with higher beta. Oil reacts. The dollar may initially strengthen before fiscal implications reprice it. But here's the scenario many analysts quietly consider most probable. No clean resolution. Deadlines get extended. Negotiations continue. Military presence remains as leverage. Trade tariffs approach expiration while Congress debates. Legal reviews continue. Nothing collapses. Nothing resolves. That environment sustains a persistent bid under metals. Gold doesn't require legislative approval. Silver doesn't depend on diplomatic breakthroughs. Both function outside the institutional friction currently unfolding. Now consider silver specifically. 5 consecutive years of supply deficits. Industrial demand from solar and electronics expanding. Imports exempt from the 15% Section 122 tariff due to critical mineral classification. A gold-silver ratio compressing from 65 to around 60 in weeks. That's not random movement. That's structural tightening. Meanwhile, gold remains the asset central banks are accumulating at over 2,500 tons annually for 3 straight years. That's not speculative retail behavior. That's sovereign balance sheet diversification. Reset again. This isn't about hype. It's about math and probability. $36 trillion in debt. Over $2 trillion added annually. Potential $175 billion in tariff refunds. Trade law overturned. Replacement tariffs expiring in 150 days, a 10 to 15-day geopolitical ultimatum. Aircraft carriers deployed. Missile red lines unresolved. Individually, each is manageable. Together, they reshape risk perception. If you're already positioned, the real question isn't, will there be volatility? It's, is the long-term trajectory intact? If you're on the sidelines, the question isn't, did I miss it? It's, is systemic uncertainty increasing or decreasing? Based on what's currently being tracked, uncertainty is not contracting. And assets that benefit from sustained uncertainty don't require dramatic panic to rise. They require steady erosion of confidence. So watch the clocks. Watch the 150-day tariff timer. Watch the Iran deadline. Watch congressional responses. Watch court developments. Watch central bank purchase data. Because this isn't a single event cycle, it's a structural shift unfolding in real time. If this breakdown helped you see the bigger picture, share it with someone who follows markets but hasn't connected these dots yet. Drop your view on which scenario plays out: deal, strike, or prolonged tension. And stay focused. The headlines will change daily. The trajectory is what matters.